We've been talking non-stop about quarterly results and the large takeaways that they have been disappointing once again. But what are the details? What has worked, what has not? Gautam Duggad, Head of Research, Motilal Oswal, Institutional Equities, joining us now for his wrap-up and review of the quarter gone by. Gautam, pleasure speaking with you as always. You know, the one thing which really, and of course you'll start with the overview where you've had a third quarter in a row where there has been single-digit growth, etc. But the small caps, the small cap miss is the big one, isn't it? Where earnings have just not matched expectations.
Yes, Tamanna, good morning. Thanks for having me. You're right, the small caps vis-a-vis the valuations at which they are trading at, the miss has been quite big in the sense that we were expecting a decline. We cover a fair bit of small caps. We have a coverage of 125 small cap companies. For them, we were expecting close to 5% earnings decline. The actual decline is 24%. And not just the aggregate headline numbers, but even the spread is very weak, I would say. Almost 55% of the small caps that we cover have missed expectations. Whereas on the contrary, if you look at mid caps, they've done fairly well. We were expecting a good growth even in mid caps, at about 17%. We got a growth of 26% for close to 90 mid caps that we cover. That being said, if you look at the 9-month numbers, because quarterly numbers obviously fluctuate a lot, and there is a lot of element of base effect which comes into play depending on the sector that you talk about. So if you look at the 9-month numbers, on a 9-month basis, mid-cap earnings are up 8%, large-cap earnings are up close to 2%, 2.5%, whereas small-cap is still down close to 18%. So small caps earnings have been weak, not just for the quarter, but even for the first 9 months of FY25.
Okay. Gautam, there are a couple of standout sectors, right? And in your report, you're talking about PSU banks and NBFCs. PSU banks in particular, I'm wondering what you think, because some of these names have gotten beaten down. At what point do you say that, considering a lot of them have reported better than expected asset quality, and you're talking about resilience in their loan book, at what point do you say that they become strong contenders to buy into?
So yes, PSU banks have posted a better than expected set of numbers. We were expecting close to 12-13% earnings growth. The actual number was 24%. And the heartening thing is that all the 6 PSU banks that we track have beaten our expectations. In fact, we've upgraded Punjab National Bank to buy rating during the quarter, while our overarching preference, as far as mid-cap is concerned, is still with, as far as the PSU banks is concerned, is still with SBI. Now, the thing is, PSU banks are still benefiting from lower credit costs. If you look at their PPOP growth, NII growth, they are broadly in a mid-single digit to low double digit. So NII growth is close to 5-6%, PPOP growth is close to 10-11%. So what happened is private banks stopped getting that benefit of lower credit costs from last 2 quarters because the base is very normalized for them as far as credit cost is concerned. Whereas PSU banks, which started benefiting from the lower credit cost slightly later into the cycle, are still accruing those benefits. I think a quarter or 2 down the line, even the PSU bank earnings will normalize. Having said that, the valuations are still very attractive for PSU banks, more so after the recent correction. You've told me obviously very selective in that space because the weightage in benchmark is still very low for PSU banks. As far as we are concerned, we have SBI in the model portfolio, and now we've upgraded Punjab National Bank as well to buy rating. But yes, fact remains that this quarter they stood out because very few sectors in the quarter managed to post 20% plus earnings growth. In fact, you can count them on fingers: healthcare, real estate, PSU banks, and capital goods, and of course, non-lending financial. So 4 or 5 sectors out of the 25 sectors that we cover. And PSU banks are a big part of, the sectors that have beaten those estimates.
Right. Gautam, morning, Neeraj here. Some pockets which posted some very good earnings, but the valuations have been high, and therefore we've seen continued correction, right? So recycling could come in there, and I'll talk to you about that later on. But I want to talk about EMS because that is one key bucket wherein the valuations were very stretched. The numbers by and large seemed okay, but we haven't seen the stocks do well because presumably because of the valuation pullback. What's the thought there now? I mean, do you reckon that a larger part of the correction is done, or is that the new bull cycle? Whenever it starts, we'll see different leaders and therefore EMS companies get relegated to the backbenches?
Sure, Neil, good morning. So 2-3 points on EMS. Clearly, EMS have a very long cycle ahead of them insofar as their fundamentals are concerned. Because the whole push from the government policy apparatus is to drive, make in India, drive PLI, manufacturing, and even the global macro trends are favorable for them. And insofar as supply chain diversification is concerned, some of those stocks had run up way ahead of the earnings, and which is why you saw a good pullback in the last 2-3 months. Some of the stocks are down 40 to 50%. As far as quarterly earnings are concerned, for the 7 companies that we track, if I remember well, the earnings growth is close to 75%, which is slightly below expectations. We were obviously expecting 100% plus growth. But do remember the fact that the quarterly profit pool of EMS companies for all the 7 companies that we track put together is somewhere about 400-500 crores. So percentage miss obviously misguides you. Valuations are still very expensive, I would say, but the growth insofar as this 7 stocks are concerned, the growth is going to be far better than the market earnings growth and some of the other sectors. But are the valuations offering you decent risk reward now after the correction? Selectively, yes. Amongst the 7 companies that we track, we saw earnings upgrade only in 1 and downgrade in about 4 to 5 companies. Our preference in EMS is still towards companies which have already demonstrated scalability, where the operating cash flows are decent, and the opportunity in the next 3 to 5 years is very meaningfully large. So we like Dixon, we like Keynes, and we like Amber, but that's about it. In the model portfolio, we still have just 1 stock because the sector obviously enjoys far less weightage. It's still not part of any big indices. But clearly, valuations had run up way ahead of their fundamentals.
To the point on M&M, I don't know, is this a case of saying that, it's good news, but it's not enough to pull this counter? And by the way, it performed really well after its earnings. I'm wondering if some of that is playing out right now, maybe some profit booking coming in. But Gautam, I'm wondering what you think about this, because you're talking about bookings of over 30,000 for its EVs in the context of about 1 lakh of EVs that were sold in the previous year. And it's a sizable number for one company to have on the first day of the launch of its products. Is that a negative in your opinion?
No, I think you're reading too much into one day's price move. Do look at the market context. The stock that you're talking about, M&M, we've liked it. It's our top idea. It's part of our model portfolio. It's hardly down 10% from its highs, I think, from 3,200 to 2,850. Market is down 20%. Small cap index is down 25%. There are a lot of number of stocks which are down anywhere between 40 to 50% now. So, we cannot make an opinion basis an opening price trigger of a stock on a particular day. Earnings have been fabulous. They've guided for double-digit growth in fourth quarter for tractor as well. And margins are also looking quite good. So, but yeah, that doesn't mean that stock cannot fall, because this has been one of the best outperformers among the top 3 performers of CY24 in Nifty 50.
Okay, just want to mark that the small caps have just inched up a little bit from the lows. In fact, it's not just a bit, by the way. Look at the intraday of the Nifty small cap. It's 0.13% now. And look at that. It's just first 5 minutes. So yes, Gautam is right. At times, TV anchors can be blamed for reading too much, too soon. But that's the nature of our business. We've not to be watching it dot to dot. As we speak, it's in the green, by the way.
Even this could be too soon.
Yeah, it could be too soon.
It depends on from where you take it.
Of course. Completely agree.
That sharp recovery has definitely given some comfort. Started brutally, but this is...
Nifty 52, by the way, 1/3%. So from being down 0.7, 0.8%, a bit of a pullback. Now, yes, like I said, could be too soon. But good time to, Gautam, just stay on, because it's interesting to watch this intraday movement and just getting a quick thoughts from Sony and Kush as well before we ask you about some other things. But just wanted to bring that going because it's market open. Sony, How do you view the first 6 minutes of trade? What do you do in a scenario like this?
So Neeraj, I think I'll still stick to what I spoke in the morning, and there could be a view, universal view, which could have actually held on to a 22,775 sort of a level. If it breaks, then further shorts can be seen. Well, it broke today; it went to 725, but then we seen the recovery. So I think it's still a sell on rise. Anywhere closer to the resistance of 23,000 would be the mark where actually you start selling again. Until and unless it does not cross that resistance band beyond 23,300, it remains quite weak, and it's difficult even to see from current levels whether you give a sell or a buy idea. I think it's quite volatile, but the idea would be to still remain hedged. It's not that we're completely out of the woods. So better to remain cautious and hedged would be the suggestion for now.
Kush, do you want to add something to that? We began the morning talking about glass half full, glass half empty. And you said that you're not even looking, so rather think out of the box. You said there is no box. So there is a matrix level play that is happening right now. What are you looking at in the near term for the markets though?
Just like Sony, I'm going to stick to the view that I had in the morning. Again, if you take that 5-year chart from COVID lows, we've pinpoint hit the rising support line at 22,275 thereabouts. That's the low. The short play is just not as lucrative. I do feel there is a sell on rise kind of a market, but I don't think the risk reward ratio is in favor. There, we could very well go on and test 22,500, but we might just test 23,000, 23,300 before we do that. So the short play from a risk reward ratio is not as lucrative. If this bounce suggests or rather steadies on for the next 15 minutes or so, you could very well see an intraday recovery, and then perhaps that short covering rally, perhaps an extended one that we've been speaking about for a while, which lasts more than a day, might just come into play.
Okay, Kush, thanks so much for joining us on this conversation. Pleasure having you as always. Gautam, I look at your model portfolio and I'm looking at the mid-cap and the small-cap space, and I see some very interesting names that would benefit from a consumption story, right? So if I'm talking about in Indian hotels in the hospitality space, if I talk about Godrej Properties as well, because there are people that are saying that real estate is going to be a beneficiary when the tax breaks come through, because it allows people to have more EMIs. I don't know what you think about that, but there are also capital market plays. Can you explain your thinking here? Why are these the most preferred picks?
Look, consumption has been a preferred choice for us for many years now, and we've been overweight on discretionaries within the consumption. We've been underweight on staples for a very long time now. And we think that as the impact of this tax cut plays through, people are going to save, people are going to consume, people are going to invest, right? So when they're going to invest or consume, where are they going to do that? I think as far as consumption is concerned, there are a whole host of segments which are going to benefit, which is why you see a broad representation of Indian hotel, a trend there, even a Page Industries, which we had added up for a very long time in our model portfolio in January. So there are a lot of bottoms up stories which are going to benefit. I don't think staples are going to benefit much, but they've derated massively in the last 4 years. And they serve as a defensive bet in such kind of markets where volatility is very high, as you just explained 5 minutes back. Insofar as investment plays are concerned, we think that the capital market story in India has a very long journey ahead. While we make a lot of hype about the number of demat accounts which got added in the last 3-4 years, we think that we're just about scratching the surface, because the overall equity penetration in household balance sheet is still very minuscule. And as incomes grow, as the awareness about equity investments go up, we think structurally the capital market plays are going to remain in vogue. And within that, brokers, exchanges, wealth managers, asset management companies, the depositories, the whole infrastructure around the capital market companies, they offer a very meaningful opportunity, and which is why we had put out a very big thematic report a couple of weeks back where we highlighted our preferences amongst the capital marketplace. So yes, we continue to like both discretionary consumption as well as investment-oriented things for capital marketplace.
Gautam, thank you so much for joining us this morning on your take on Q3. So while it's seeming a little dismal right now, the outlook definitely continues to be positive in the longer term.